Again, welcome Dr. Ryan and Dr. Bhaskar to Light in the Markets Maze. This is episode number 4. I am Mehdi Fishtali, the CEO and founder of Finamaze. We are October 14th, and today we're going to talk about the markets. We're going to talk about the US inflation, employment, Fed. But prior to that, Dr. Ryan had announced in our first episode that one of the targets of the S&P would be 3,500 points. And that's exactly what we hit yesterday because of the high level figure of the inflation. But soon after, it went the other way around. So, Dr. Ryan, was it that the market is thinking that inflation has peaked and that therefore we will have less reaction from the Fed, and that the tightening policy of the Fed has given some results, or is it simply a technical rebound, what some people call a bear market short-term rally?
Well, hello everyone. Thank you, Mehdi. Great to be back again on another episode. So the 3,500 target obviously was not my sole target to me. There were many other investors who had this target as well. So I'm not much smarter than many other professional and sophisticated investors. Now, what happens at 3,500 basically is that the gamma goes through the roof on the S&P 500, literally through the roof. And many of the people who use puts to hedge, who have short positions, basically, it gets triggered. And this is precisely what happened yesterday. So when speaking to several players on the markets, they will tell you that basically many unwinds on the puts happened. Lots of the short covering happened as well, taking profit on all of these hedges, and which created this enormous knee jerk that we have seen. And funnily enough, if you go to October 13th, 2008, yesterday was October 13th, 2022, exactly the same thing happened. The Dow Jones jumped by 936 points on October 13th, 2008. And yesterday it jumped by 800 points. It was again puts being unwound. It was short covering. And we know exactly what happened afterwards in 2008. So for me, this is purely technical and it's not based on speculation. It's based on discussions I'm having with the street.
So, Dr. Ryan, you see that there are still some risks on the stock markets for the midterm.
It's actually very simple and straightforward. First of all, we are in an aggressively rising interest rate environment. That's one. That means margins are being compressed. Financing is much more expensive, particularly for more vulnerable companies who rely on debt. And four, we are in a very intense geopolitical situation. These four are very unfavorable to equities markets, meaning that stock markets, in our opinion, should continue the drop. We've had that rebound. We will test 3,500 again. And the next target that I'll be looking at, it's not yet finalized, it's 3,200. But again, all things equal, ceteris paribus.
Excellent. Dr. Bhaskar, so what's your take on this? Particularly, how would you have your macro analysis when it comes to employment and the inflation? Are we in a recession or not? Employment is still high, isn't it?
I wish I could give you an economically coherent answer, but I suspect both Dr. Ryan and me, we have thrown our economics textbook out of the window. I have never seen a situation where you have such high levels of interest rate and trends, inflation, geopolitical issues, but still unemployment is plumbing new depths and employment figures are rising. Putting it another way, despite all the efforts of the various central banks to try and cool down the economy to reduce inflation, it doesn't seem to be coming through because people are still hiring. Now, you can argue that this could be because COVID removed quite a lot of productive people from the economy. Therefore, you're talking about very few people who are coming through into the market, or you're talking about reshoring, or you're talking about the animal spirits springing up. Be that as it may, insofar as the war for talent and hiring is concerned, it is still high. Now, how the employment figures or unemployment figures, depends upon how you look, is a key indicator for central banks to set their interest rates. So my suspicion is that they're going to keep on increasing the interest rates to get inflation under control because of the employment situation.
So, Dr. Ryan, isn't the situation fully profiting to the almighty US dollar? And for how long will this continue? And will we see a reversal once the other central banks will realize that the only way forward is an aggressive interest rate tightening? Isn't the dollar profiting from the fact that the Fed has been the first and the most aggressive tightener, I would say, of the rates?
Now, the what seemingly looks like a strength in the US dollar, I don't really see it as a strength in the US dollar. Then it's actually the weakness of the currencies of the rest of the world. That's how I see it. Okay, so I'm going to share now a graph quickly. So basically, this shows you who is exposed to US Treasuries. And as you can see, it's the rest of the world that is exposed to US Treasuries. And US Treasuries have completely got destroyed in value because of this interest rising environment. So here, the rest of the world on a market basis is losing a lot of money on these positions. And particularly emerging markets who are weakening in the face of what is happening at the moment in this current environment. So on a mark-to-market basis, the rest of the world is losing money, hence their economies are weakening, hence their currencies are weakening with respect to the dollar. So that's how I see it more, rather than just a pure weakness of the US dollar. I'm going to show you another very interesting graph as well.
Strength of the US dollar. So for you, it is not only a difference of the reactivity between the Fed, the US Federal Central Bank, and the rest of the world. It's also because the wealth of the other countries when it comes to US Treasuries has simply be put at stake.
It's weakening. Now, it's never one single factor that causes this. It's a list of factors. One of them is, yes, obviously interest rates are rising on the US dollar. The US dollar is a currency you go to when you're negative about the economy. So that's another reason. But for me, one of the primary reasons is the weakening of the rest of the world compared to the United States. As Dr. Bhaskar mentioned, employment is extremely strong in the United States. We are at 3.5% unemployment, which is lower than the long-term unemployment rate. And the US economy is really firing on all cylinders. People are spending money, they are buying. And I think we're still living in the general knee jerk that followed the pandemic. People are traveling, they want to spend money, they want to have fun, they want to buy stuff. So the US is benefiting from that. So another graph I just wanted to show just very quickly, and I have to show it because it's extremely rare to have this situation. So this shows you US stocks versus bond returns since 1926 to 2022. So as you can see in the lower left quadrant, it shows you when US stock returns and US bond returns are very much correlated on the negative side. So they are both going down. This happened 3 times in history: 1931, 1969, and now in 2022. This is an extremely rare event that we're going through right now, and it's transformational. I'll leave the listeners and people who are watching us to see what happens after 1931 and 1969. Let's hope it doesn't show what will happen in 2023.
Very good graph, and indeed, Dr. Ryan, that reflects and mirrors what all the investors in the market who are adopting a relatively diversified strategy, investing 60% in equity and 40% in fixed income. That's one of the backbone of the asset management industry that's today's failing. And I would completely agree with you and add that perhaps now it's time to turn to some active fund managers who, beyond the passive 60-40% kind of diversification, are more looking towards either private equity, either towards USD or Swiss franc, or some long short strategy. We'll leave this as at the end for our conclusion. But earlier on, you said, Dr. Ryan, that pension funds and also one of the biggest holders of the treasuries of the government bonds. That's also the case in England. And here I would like to turn to Dr. Bhaskar in order to ask him, what the hell happened in UK for the past 2 weeks? The gilt went up and down in movement never seen in history.
I wish I knew. I mean, like this is like a slow-moving train crash, and I didn't know about this liability-driven investment. But I think just to step back a bit, you talked about that what a lot of asset managers have got a substantial portion of their investments in fixed income. Let's not forget that the pension fund industry is very heavily exposed to the govie sector, so to say. And what specifically happened within the UK, the political imperatives literally are extraordinary, because you have on one hand the central bank, Bank of England, trying to actively slow down the economy to control inflation. On the other hand, you've got the government trying to cut taxes and to boost growth, and at the same time putting together a package of measures to control energy costs. So this is like schizophrenia at least about 3 to 5 standard deviation levels. So no wonder the markets got seriously spooked. And then what has happened is obviously the liability-driven investment issues that the pension fund industry is facing, they got spooked, and clearly the large amount of collateral that they needed caused a huge ruction. So if you look at the gilt yield curve, its behavior is extraordinary. And by the time your listeners actually listen to this, we would have finished Friday, which is the time that the governor of the Bank of England has given guidance that he's no longer going to support the yield curve. Now, how that is going to play through, will the government row back on its macroeconomic policies? What's going to happen in terms of contagion? My biggest worry is that we don't know what other time bombs are hidden in other pension funds, not just in the UK, but in Europe and US as well. And seriously, one of my biggest worries is that once the interest rates go up and weird kind of correlations start coming through, what is going to happen? I mean, one very interesting factoid came out yesterday that you have less volatility on Bitcoin compared to quite a lot of other assets. I mean, what can you say? So to summarize and answer your question about what's happening in the UK, we just don't know. And the reputation that the government and central bank had of economic competence is severely shaken. This is not a good thing. This is not going to end well.
So one last 2 points to discuss before we end up this episode: oil and the economic winter coming to Europe. Dr. Ryan, you perhaps want to take the first one on oil?
Yes, on oil. So the OPEC Plus has been very much criticized for cutting production by 2 million barrels. It was described as political, as against the West, against the US, etc. And I don't see it this way at all, because OPEC basically is an organization that has a primary role to control the price of oil and keep it stable. Because what affects users of oil and buyers of oil the most is volatility. When you have volatility, airlines and all mass users of oil get affected very seriously. So OPEC wants to stabilize the price of oil. So basically, we look back to a few years ago when oil prices dropped below $30, what did the OPEC do? They basically didn't do anything. So Saudi Arabia was dipping into its sovereign wealth fund to plug its budget deficits. They did not cut production or do anything aggressive. They kept the price stable. So today what happens is that the price of oil is being quite volatile and they're seeing a slowdown in demand for oil, so they drop production. It's a purely technical decision that was taken. Now, had it been political, after the cut of 2 million barrels, if it were really political, I would have seen the price of oil jump substantially. What happened? Nothing. It remained completely stable, which shows that the decision is actually quite technical rather than political. So lots of politics is happening around the world, positioning, posturing with respect to Russia, Ukraine, etc. So we're seeing a lot of this in the media. But again, I see OPEC's decision as purely technical rather than anything else.
Indeed, Dr. Ryan, and oil is still in the sub 100 levels between 85 and 95, which was the case just a few weeks back. Dr. Bhaskar, would you tell us a little bit about the difficult winter that's coming through Europe? We have seen this week that Germany has got 70-year high interest rate, high inflation, more than 10%. We remember from our history textbooks about the Weimar Republic and the hyperinflation that basically hit Germany, and that really put a strong stance on the central bank, the Bundesbank before, and today the ECB. Inflation needs to be fought and to be put at low levels. With these levels that high, the central bank of the ECB will be willing to increase the rates. It will happen at the time where the energy is difficult to get in Europe because of what's happening in Ukraine, and because of the recession that is looming. So what will be the solution for Europeans?
So let me give you an example let me give you my views on what could be a best case scenario and the worst case scenario. The best case scenario could be is that Europe manages to find alternative sources of energy, starts to have stockpiles of gas, provides public subsidies and caps on fuel prices, and it staggers through the winter. That's the best case scenario. And it also presumes that the war in Ukraine is relatively stable. The worst case scenario that does happen, we currently have got political instability in Italy. We have got a serious case, industrial unrest in France. You have got energy costs getting seriously excited in the Iberian Peninsula. Germany, we have already talked about. So the worst case scenario, whilst I don't think that it will ever reach the Weimar Republic levels of hyperinflation, the European Central Bank, egged on with the Bundesbank, can and very rapidly increase the interest rates to punitive levels. I don't think there is any political appetite at all to let inflation run rampant. There is one more thing that is happening, which I'm not sure whether you gentlemen noticed, but the European Commission has literally run out of money. 2 years into the 7-year budget cycle, it has run out of cash. So I expect that over the next few months, the European Central Bank is going to do much more of controls and get the inflation under control.
Indeed. So perhaps to conclude, if I may ask you, in these turbulent times and uncertainties, Dr. Ryan, where are you putting your money?
Well, very good question. I haven't changed the allocation since April, basically. The only thing that changes is increasing the cash allocation from 40% to 50% and switching from US dollar to Swiss franc as soon as the Swiss franc US dollar rate crossed the 1. So now the bigger cash allocation is on the Swiss franc. The biggest inflation hedge in the portfolio is basically focused on private equity. because I do suspect all of the turmoil we're going through at the moment will last around 3 years until things normalize geopolitically, economically, and etc., which is a shorter cycle for private equity. And then there's a bucket for long-short strategies on credit derivatives. This is to generate carry, so we're long carry. And the convex strategy basically ensures immunity from the volatility of the market. So this is mainly the allocation. For us, if we compare inflation to recessions, for us, inflation is like cancer. If we want to compare it to human beings, it just eats everything in an indiscriminate way. Whereas a recession is a flu, okay? So I'd have a flu any time of the day over cancer, and the portfolio is positioned as such.
Thank you, Dr. Ryan, for this view. Dr. Bhaskar, where will you put your money?
So I'm afraid I'm still a bit of a bigger believer in the US economy. So I have increased my allocation to the US economy. And reduced it for Europe and UK. I have also increased my cash allocation and also starting to increase my angel investing proposition as well, because I think some of the startups that I'm not as operating on as big scale as Dr. Ryan on the private equity side, but on the startup side, I think some very, very interesting startups are coming in, which I'm looking to invest in. But I'm keeping my powder dry. I would agree with Dr. Ryan, almost about 50% right now is in cash, because I suspect over the next 6 months, some very, very good bargains should come up.
So Mehdi, just to say one last thing, maybe. We sound very negative. However, I do fundamentally believe we will have, not very long, generational entry point to buy back risky assets. Literally a once in a lifetime opportunity to buy risky assets, but it's not today. It will come, but it's not today. Once we have it, we can literally go on retirement and let the portfolios run.
Thank you, Dr. Ryan. So perhaps my turn to answer this question. So I put money in interest rate or yield correlated portfolios. And also for those who follow us, we have our Black Swan strategy that is basically, to summarize, long as short strategy, long defensive stocks and short risky stocks, as well as investing in a little bit more agri commodities and interest rates. So this is a way for us to diversify from the 60-40% general allocation. As you all know, the S&P lost 25% and the fixed income broadly minus 16%. This strategy, on the contrary, generated over 30% year to date. Thank you very much all for being with us. Thank you, Dr. Ryan. Thank you, Dr. Bhaskar. Always a pleasure. And we look forward to our next episode just 4 weeks from now.
Finamaze. Amazingly smart, amazingly you.